Right. So coming to the next concept-wise case study, again from the chapter number 4 over there, the materiality, risk assessment, and internal control. Okay. Right. So following is extract of information taken from the draft financial statements of Find Me Limited manufacturing of bicycles put up before you for audit for 22-23. Revenue, cost of sales, gross profit, operating expenses, finance cost, depreciation, amortization, PBT, tax expense, deferred tax, total tax expense, tax receivable, and the inventory. Company has not made any substantial addition to its plant capacity during the year. It has reduced its dealer network and is approaching customers directly using the online platform. Encouraging response has been received from customers and sales have gathered momentum through the online platform. You are planning to use analytical procedure as the risk assessment procedure. Keeping in view of the above, answer the following question. Revenue from operations of the company, right? So 25,000 and now this year 35,000, right? In the year 2022, has 23 has increased by 40% as compared to the last year. There are no additions in the plant capacity. Which of the following statements is most appropriate? There is an audit risk that revenue from operations is overstated from 25 to 35,000. There is an audit risk that revenue from operations is not overstated. There is an audit risk that fresh customers of the company do not make the payment. There is an audit risk that company is overutilizing its plant capacity, leading to rapid plant obsolescence. So those people know think in a weird manner, something which is absolutely unrelated. That point would be for them. Right? So there is an audit risk that revenue operations is overstated. Revenue from operations is overstated. The expenses of 21-22 and 22-23 are the same. So operating expenses 3825. Right? Which of the following statements is most appropriate in the overall context of the case study? Operating expenses figures of 2 years can be the same. There is no audit risk involved. It is an anomaly. It is an exception. However, there is no audit risk involved. There is an audit risk that previous year figures needs to be revised under the Companies Act. So interesting. There is an audit risk that previous year figures have been presented in the place of the current year figures in the draft financial statement. So by mistake, the current year figure has not been put over there in the yes current year figure, and just the previous year figure has been put. And this is what you say a drawback of copy paste. Okay. Trade receivable turnover ratio has increased from 1.44 months in 21-22 to more than 2 months in 22-23. Identify the most appropriate statement. In direct distribution online, through the online platform, trade receivable turnover ratio is estimated to be high. Therefore, there is no audit risk involved. In the direct distribution through online platform, trade receivable turnover ratio should have fallen. Therefore, there is no audit risk involved. In direct distribution through the online platform, trade receivable turnover ratio should have fallen. It is possible that some of the dealers may not be meeting their commitments of past contract. Therefore, there is audit risk that trade receivable could be undervalued. And then direct distribution through online platform, trade receivable turnover ratio should have fallen. So in all cases, what are they saying? Three cases over here, it should have fallen. It is possible that some of the dealers may not be able to meet their commitment of the past contracts, and therefore there is an audit risk that trade receivable could be overvalued and not undervalued. Right, that the higher amount of the trade receivable could be shown. Okay, so trade receivable last year 3,000, this year 6,000. Right, so they are not making the adequate provision for the bad and doubtful debt. Right, so there is a risk that the trade receivable could be overvalued because instead of 3,000, they are showing it as compared to last year 3,000 lakhs. This year they are showing it as the 6,000 lakhs. Okay. The GP of the company has increased by 3% during the year in comparison to the last year. Which of the following statement is there is an audit risk that there is an overstatement of the cost of sale. There is an audit risk that margins with the customers may have increased. There is a risk that closing inventories may be undervalued. There is an audit risk that cost of sales may not be completely recorded. Right, so if closing inventories may be undervalued, again, then the gross profit ratio over there, closing inventories, that means the credit side of the P&L is increasing over there. Right, so it would increase by 3% as compared to the last year. Right, overstatement of the cost of sale or margins with customers might have increased. No, because online sales there is more competition over there. Right, so there is a risk that cost of sales may not be completely recorded because anyways you look operating expenses, they copy pasted the previous year figures over there. Right, so also there could be an error that the cost of sales may not be completely recorded. right? So cost of sales may be not be completely recorded, and that is why it's just showing an increase in the gross profit ratio, because actually the sales have also, in the sales of the company have increased. So correspondingly, the cost of sales should also increase. Inventory turnover ratio has increased from 2.88 months in 21-22 to about 3.42 months in 22-23. Which of the following statement is likely to be in accordance with the overall context of the case study? Revenue jump in the current year may have led to need for raising inventory holding levels. Therefore, there is an audit risk pertaining to misstatement of inventory. Raising of inventory level may raise locked up funds in inventory. There is an audit risk that could lead to rise in costs. Revenue jump in the current year may have led to need for raising inventory holding level. However, there is also a risk that some of the inventories at the dealers, which could have become obsolete, it also leads to the audit risk that inventories may be overvalued. There is an audit risk on account of both the factors, both B and C. Right. So what is the factor over here? C. Revenue jump in the current year may have led to the need for raising the inventory. However, there is a possibility that the inventory which is there with the dealers, it might have become obsolete, and that is why the inventories could be overvalued. Right. That is why the inventories could be overvalued. Right. So more or less, it's all the questions regarding the risk involved over there. Right. And all the points we are talking about the audit risk which is involved. Okay.